Hey everyone, I've been having some conversations with clients lately. I have conversations with clients all the time. However, what I found is a lot of them could use an update on what things are in terms of the market, both economically and in local real estate. So I thought I would record this presentation that I just gave on this past Saturday at the Island meeting that was hosted in Whitby. Here's a very common goal that I see among new investors that come to me. They say, I want to cash flow $10,000 a month. How do I do it? Now, 10,000 is it's pretty close to what to two teachers' pensions or two government pensions. I had a recent guest on the show who's a teacher, and he was saying that his pension would have been between 60,000, 65,000 a year. That's close to 5,000 a month. So for two adults, that'd be around 10,000 a month. So how do you do it? So honest answer, without being independently wealthy to buy a lot of real estate or investing in never heard of town before, which typically is a small town. I've seen this many times. You know, before I met Elizabeth Kelly, I had no idea where Kirkland Lake was. Without taking such a strategy of investing in a really small town where you're targeting cash flow and getting minimal appreciation, I don't know how else you do it. Now, understand that most investors are not willing to uproot their lives and move 4 hours away in order to start a real estate business in order to generate 5-figure cash flow. So yeah, I honestly have no idea how to do it. But then when the investor asked me, I actually after I got off the call, I recalled Tim Collins has done it. So for those of you who've been around me for a while, with my client Tim Collins, one of my longest time real estate investor clients. I think we accumulated somewhere around 6 income properties, almost all student rentals. And in 2021, he liquidated his entire real estate portfolio, including his home and his condo home. He had 2 houses basically. He had a condo and a house. Liquidated everything, put a whole bunch of it into the stock market to earn dividend income and invest in high yield ETFs. And now he earns over 10,000 a month in truly passive income. Now, the lesson here, though, is that he built the foundation of his stock portfolio came entirely from real estate. He made all that money in real estate in order to generate that passive income. So then my point, though, is that a lot of my clients, like a lot of you clients who are listening to this, you can already do exactly what Tim does. It's just that Tim's goals are very much around being passive and being, having not much going on. He wants to live a low stress life versus many of you are go-getters and you want to grow your net worth even more. So your goals are different. But again, I honest to goodness, what Tim has is available to many of us. It's available to Cherry and I. It's just, again, Cherry and I choose to continue and hold income properties because they increase our net worth so much. So ignore the agenda. Just so you know, we do have an April meeting, April 22nd. We will be touring properties as well. And also we'll likely have a May tour as well. It will likely be in the east side of the GTA. And then June we'll be back in the Oakville, Hamilton area. So those are the dates. So in case you've been living under a rock, there's a global banking crisis going on right now. So there's SVB, there's 2 other regional banks. SVB was just recently bought for likely pennies on the dollar. Credit Suisse is now gone, Credit Suisse Group. So one of the 3 major banks in Switzerland are now gone. And it's kind of funny because I remember growing up and watching movies, and the characters were always saying like the money's in the Swiss bank. Put your money in the Swiss bank. So I guess that didn't work out for those Swiss banks. So now there's only 1 national bank in Switzerland. They're down from 3, as UBS was basically made by the government to buy Credit Suisse. Anyways, and then now making headlines right now is Deutsche Bank is seeming to have some issues. The stock's getting hit. But they'll likely be bailed out. But also understand, like, bailing out means printing of money, right? This from 2 weekends ago now. Like the bank can't. I'm actually surprised. Like you had very high level government employees, the heads of the major central banks in the world, meet on a weekend to decide that they would backstop the banks. That they would not all of them, but they would increase liquidity, which means, going into debt, creating more money so that there's more money in order to back the banks. So the banks would have money so they wouldn't go broke, right? Give confidence to the market, give confidence to the banks, give confidence to deposit holders, whatnot. But that all means inflationary, meaning there's going to be more money in the system, and more money in the system means interest rates fall, right? Bond prices go up, bond yields go down. Bond yields go down mean more interest rates go down on fixed rates. But before we get to fixed rates, let's talk about the U.S. Federal Reserve. So this, don't look at the chart right now, but this is CME Group's Federal Reserve Watch tool. So this changes frequently. For example, 2 weeks ago, the market in the U.S. believed that there would be 2 interest rate increases, 0.25, which happened last week, and they were expecting another 0.25 in either May or June, right? And no interest rate cuts until next year. That's what the market was saying just 2 weeks ago. Now, fast forward today, I took the screen capture to this morning. Now we're seeing that the market still thinks there may be a rate increase, but the highest probability chance is no raise. So from 2 weeks ago, like pretty much guaranteed raise, to chance of no raise. And again, as I mentioned, 2 weeks ago, no one thought the Fed was going to cut rates this year. But you see that, starting the highest probability of a cut looks like to be September, and then cuts from there on, right? And then remember, Canada, we were ahead of the US Fed in terms of raising rates. In theory, we should cut before they do. Also, based on our inflation data has been better than the Americans. So again, that would lead one to believe that we will cut before the Americans. Yield curve is falling, as I mentioned. Bond prices in Canada are going up, so therefore yields go down. Like how much they pay out goes down. The cost of bond, the yield of the bond goes down. Therefore, that has implications to the fixed rate market, the mortgage fixed rate market. So I pulled this on Friday. For example, the 5-year fixed. I remember being at the Rockstar event about a month ago, and everything was like mid to high 6 in terms of 5-year rates. You see here on this website, rates.ca, someone can get as low as 4.59 on a 5-year fixed. I saw on Twitter someone got a 4.7 at HSBC. That's likely personal, so investors, we're going to pay more. But again, we're down significantly from just a month ago in terms of fixed rates. And here's another chart. Here's a 2-year Canadian bond. We're not seeing discounts at the 2-year fixed rate yet, but we should hopefully soon, as the government 2-year government bond, the yield rate has come down significantly. As you can see on this chart, it's come down about 0.7 or so. It's coming back up right now as the market is getting more confident that we're not in a major banking crisis. But who knows? Who knows if there's not another shoe to drop with another major bank having issues? My money would be there's more issues. And then we'll continue to see bond yields fall. And in turn, you'll see mortgage interest rates, fixed rates come down even further. And then my point about fixed rates is that the majority of Canadians, non-investors, you actually get fixed rates. So rates are coming down. That will just trigger more buying activity. That's just going to give more stimulus to the real estate market to continue its climb. Quick comment on the federal budget. I'll look at the like that dark purple line, the top line there. That's the federal. That's the federal government's employment level. See that notice they're outpacing both municipal and provincial. What's odd though is even the article states like the federal government's not responsible for our greatest areas of inflation, which would be like healthcare, nurses, and doctors, which are incredibly important people. We need more of them. Teachers, right? The province is responsible for those. So the province is that light blue line, the one in the middle. So what is the federal government doing? Why are they hiring so much? Because I honestly don't know. I don't know why they have such priority when our biggest issues in Canada as Canadians is in our healthcare. and after that, our education system. Anyway, so yeah, more money printing for Canadians. Expect the the Bank of Canada is just continue to print more money. Expect more inflation. And if you don't believe that inflation is a problem, here's a tweet from Lynn Alden, who's a wonderful content provider around economics and money. You see that as of 1971, which is when in the US was the end of the gold standard, and then inflation's taken off ever since then. So one could predict until we return to some sort of standard, we will never see a control to inflation. So it might be a good idea to hold some inflation fighting assets, right? So I'm always trying to be open-minded. I have always lots of questions. Typically, I ask Google questions, but with this ChatGPT thing, it's proving to be pretty smart. It's actually learning. It's getting better. It's incredible how smart it is. For example, ChatGPT it passed law school exams and business school exams. The business school is particularly interesting because it passed University of Pennsylvania's Wharton School of Business, which is generally considered a top 5 business school in the US, if not the world. Anyways, so AI is pretty smart. So I decided to ask, I'll ask AI, hey, ChatGPT, how to hedge against inflation. So here's the results, right? You can go do this yourself. You likely get a slightly different result than I will. It's a little interesting that way. And just pro tip as well, if you're not sure how to use ChatGPT, you talk to it as if it's a human being. Like if that's what you're most comfortable doing, for most people, we're not programmers. Just talk to it as if it's a human being. How do you hedge against inflation? So number 2 answer is invest in real estate, right? I think we all know that. Academically, that's always been the answer. And then I thought this was interesting. Increase your income, which is, increase your income. But also in point number 5, it actually says investing in income generating assets, such as rental properties. So twice the answer is real estate. I just thought that was interesting, right? And again, for those who don't know, we have over 45 clients who've made over $1 million or more in real estate in the houses that we've sold them. So my point though is here, in my experience, I don't see the success rate in other money making areas like stocks or like Bitcoin or whatnot. I know I've never met so many people in my life, either within our own clients or at other networking groups. Like for example, I'm a 10-year member of RAIN. I've never met so many millionaires in one place, and they're all in the same asset class, which is real estate. And again, all these people can replicate what Tim has. You've made enough net worth, you've built up enough money, enough equity in order to, should you choose to, liquidate a bunch of it and put it into something that yields more cash flow, like a high yield ETF or big dividend paying stocks. So has the market bottomed? So based on Treb real estate market, I'll just show you the data. I like showing people data so they can decide for themselves. So here's some data points. So I got this off Treb's website. So this is publicly available information. Anyone can get this. Notice that listings have fallen 40% year over year, 40%. So when you see people saying there's no supply, there's no inventory, they're talking about listings because they've fallen off. Like no one's selling, not no one, but it's significantly reduced, 40% less new listings, right? Days on market. So February was like the peak of the market. So 9 days on market, which is absolutely insane. It would take only 9 days on average for a property to sell, right? Then this past February, 22 days on market. That is still a seller's market. So for anyone who thinks this is a buyer's market, not based on this data, because understand from my experience, when I started in real estate as a real estate agent back in 2010, days on market in Hamilton were over 45 days. So this current market is less than half of that, right? Here's the home price index again from Treb. If you look closely, it looks like we're trending up after we've come down from the peak in February. Looks like we're trending up already. And based on the data that's available, it looks like we're going to continue to slowly climb up. Because never forget, we are in the middle of a housing supply crisis, right? We're in the middle of a housing crisis. Here's the supply side, right? The province has a goal of 1.5 million homes being built over the next 10 years. However, the province has never built even 750,000. We've never even built half of that goal over a 10-year period. And then also just something to highlight. Notice that the yellow data points, those are apartment condos. Generally, they're apartment condos. Notice that is trending up versus anything that's based on land, which is in the blue, like houses, semis, townhouses, that's trending down. So as an investor, I want to own what's in short supply, right? I want to own what's on land. Hence, my entire portfolio is on land, except my office, like sort of. But yeah, but all my residential rental properties are all on land, and that is always my preference, is because land is truly the hardest asset there is. We have a demand crisis as well. So understand, like, data hasn't always been easy to get. For example, the non-permanent resident number hasn't always been publicly available. So while all these Alberta bulls are always saying like, oh, everyone's leaving Ontario, coming to Alberta, well, not everyone. You can actually see the number in the top right. Like Ontario lost 130,000 people, but we gained 80,000, and we gained almost 185,000 immigrants. And that non-permanent resident number is just absolutely enormous, 305,000, right? So for a net gain for Ontario, 445,000 new people in Ontario in just last year, 2022. So understand, like, Hamilton is 500,000 people. We have almost a new Hamilton in the province in terms of population. Like, that is big. That is big. Like, Ottawa, I think, is like 700,000, and Ottawa is our second largest city in Ontario. 445,000 is a lot of people, and likely a lot of them will need a house, a roof over their head, which I'm happy to provide. And also understand the non-permanent resident number. The majority of those are international students here on visa. Yes, wow. Isn't the market going to flood with power of sales? Are we going to see a dip this market? So I actually did think there was going to be a dip in the spring market. However, Ron disagrees with me. So I follow Ron Butler on Twitter. For those who know Dave Butler, this is Dave's dad. Dave and Ron don't always see eye to eye. What's interesting about Ron is that he is likely the biggest real estate bear I know, as in he's been saying the market was going to drop for basically as long as I've followed him, which is like 2010ish. And my understanding is that Ron sold his house back like around then, and rents. I don't know if that's still the case, but he was willing to put his money where his mouth was. He's saying the market was going to fall, rates won't stay low, and so he exited the market. So again, likely the biggest real estate bear I know, and even he's saying, I've circled it I circled one of his posts on his Twitter. There's not nearly enough power of sales so far to materially affect what's available for housing inventory or reduce average prices. So I also understand that Ron is, I think, like the number 4 mortgage broker in Ontario or Canada. So he sees a lot of volume. I love talking to people who have a lot of data points available to them to make decisions. So Ron, again, is a very large mortgage broker, owns a very large mortgage brokerage, and he's even saying, and again, his bias is towards bearish, and he's saying that we're not going to see a whole lot of power of sales. So yeah. Inventory on the decline. If you've talked to any realtor or follow any of them on Twitter, we're all complaining that there's not enough inventory. And as you can see, the trend has been down in terms of inventory. And when you have low inventory, that just naturally puts pressure on prices to go up. And never forget this article. So please go read it. I provide the link. There, the source. So to quote the chief economist of the CMHC, he believes that the average home price will fully recover by the end of next year, 2024, and will surpass peak by 2025. Now, that's an average piece of real estate. I would never recommend anyone purchase an average piece of real estate. We are almost pretty much always looking for the top 4%, right? So if you get an above average, a well above average property, you should very well beat the average return. But let's talk about the average return. So what is the average return? So what if average real estate were to surpass peak in 2025? I'm actually going to do some math as if we return to peak, right? So again, TREB numbers. Last year, peak price was about 1.3. Current for this year's price 1.1, right? That's a fall of about 18%. Now for recovery, the price has to go up about 22%, right? Fall 18%, has to recover 22% roughly in order to return to, that's the type of appreciation you need to see to return to peak, right? So run the numbers, same numbers that you see here on the screen. The difference between February last year and this year is about 238,000. So even if you bought an average piece of real estate with 35% down, your return would be, if this all works out, based on what the chief economist of CMHC says, your return would be around 238,000, which works out to a 62% return based on the 35% down. Now, can you find me something that beats that? And that's for an average piece of real estate, right? So please, if you know something that beat that you're willing to sink $400,000 in, that you're willing to bet $400,000 in, that will return something like that, then please let me know, because I'm completely open-minded and I'd love to make money. Now, if any of these things say that if you cannot afford such a down payment, I cannot recommend enough that you just buddy up. And that's the reality of things. Almost all of our clients, and you ask any mortgage person out there, anyone who's buying generally has help, either from parents, grandparents, or like here's Kyle and Matt. They're longtime friends. They're both teachers. They share values. They have complementary business skills. They're 50-50 on everything, right? So if you cannot afford one of these properties, go 50-50 on everything. Split up the work. That way you have the same return on investment and less work, right? Less work sounds good. Sounds great to me. So again, clients, I'm always happy to discuss active and passive real estate investments or anything real estate. If you want to talk about like where you live, where your home and whatnot, right? I was speaking to a gentleman yesterday who lives in Calgary. We're talking about where to live as well, right? Appreciate that we have over 350 clients. I have some significant entrepreneur experience as well. I belong to Entrepreneurs Organization. I'm very close to 130 entrepreneurs who are all 7-figure entrepreneurs. I'm on the same path to learning the truth about real estate investing, but really the truth I'm looking for is how to be successful in life and raise happy and healthy kids, make a lot of money so they can work less in the future. That is the truth of what I'm after. So if you're interested in learning more, booking a call with me, free call. Note there is some homework to do, but it's a free call, QR code's there, and you often see the emails from me. So yeah, you know how to reach me. Don't be shy. I have around 5 calls with clients a week, and generally I think they're going pretty well. Again, happy to talk about both active and passive opportunities, and also anything real estate in terms of your home or where you want to live or where your kids want to live, right? I was speaking to a client just last week who's retiring, who wants to move, be closer to her kids, and so we have those conversations as well. Happy to help people on moving, relocating as well. All right. So that's everything. All right. Any questions? You know where to reach me. Don't be a stranger. I think I'm always happy to talk real estate. Talk to you soon. Thank you for watching. If you want to learn how to invest in real estate from scratch, my team teaches beginners how to use the #1 investment strategy that I personally use in a virtual free training class every month. Go to investortraining.ca/YouTube to register for our next class. The link is also in the description as well. I publish at least 2 to 3 videos a week here, so subscribe if you want to keep learning from seasoned investors like myself and my guests. And if you're just starting out, feel free to ask questions and comment below, and I do the best to answer each of those comments and questions myself. Again, if you're ready to learn the nitty-gritty about real estate investing from a professional investor, register for our next virtual class. That's at investortraining.ca/YouTube. Thanks again for watching. See you in the next video.